Ed Yardeni is now joining us, President at Yardeni Research. Ed, good morning. Good to have you with us here on CNBC-TV18. It's always a pleasure. Uh, Ed, will the jobs data change anything at all? Because on Friday, we also had the University of Michigan inflation expectations, which were softer, so it kind of balanced it out a little bit, sentiment-wise. So on Wednesday, when the Fed meets, should we expect a hold still?
Well, I think what the stock market has learned is that we can actually see inflation moderate without a recession. We don't have to have a recession in the United States to bring inflation down in the U.S. because China and Europe are doing it for us. China's in a recession. Europe is in a recession. And as a result of that, particularly China, as you mentioned, China's PPI and CPI were both in negative territory on a year-over-year basis. And China's exporting deflation to the rest of the world. And that's actually a good thing for us in the United States. It's a good thing for you folks in India. It's not good in China because they have a property bubble that's burst. But as a result of that, their goods prices have been deflating, and that's helping to bring inflation down in the rest of the world.
So what are you expecting from the US Fed in terms of commentary, Ed? Because the indication is that the Fed could begin cutting interest rates earlier than what the market is anticipating. What are we looking at in terms of a timeline? And do you think there could be any hint of that at all in the policy this time around?
Well, I do expect a hint. And I think what Fed Chair Powell will say, because I don't think he'll say it in his prepared remarks, but he undoubtedly will get lots of questions from the reporters at the press conference on Wednesday. And I think the reporter will say, you know, what's it going to take to have you folks cut interest rates and by how much? And I think what Powell will have to say is that if inflation continues to moderate, he'll have to acknowledge that it's coming down. And I expect that the CPI on Tuesday will confirm that. If so, then I think Powell will say that if inflation continues to head down towards our 2% target next year, then we will most likely be lowering short-term interest rates. Because if we don't lower the federal funds rate and just keep it here, and inflation continues to moderate, they would actually be more restrictive. So I think he'll acknowledge that. At the same time, I think he's going to want everybody cool their jets. He doesn't want to see too much optimism about the Fed lowering interest rates, because I think they want to maintain restrictive interest rates to make sure that inflation stays down. And that's perfectly fine if the economy remains resilient, which I think it will.
Hi, Ed. Good morning. What about the Indian markets? Well, we are thumping the table because political stability is likely to continue. Maybe the US Fed is done with regard to those hikes in interest rates. And crude oil prices, you know, it's tried a couple of times this year to move around that $100 per barrel. That's not happened. So for us, it's a Goldilocks scenario that's playing out. What about the Indian markets? How do you think the globe is approaching it?
Well, I think if you make a checklist of what could go right, I think we're checking all the boxes. We're seeing that inflation is moderating worldwide and in India because oil prices are down. We're saying that the Fed's done raising interest rates, and people are talking about how low interest rates will go next year. I think the one thing that still is not in favor of emerging economies generally is weak commodity prices. But India is not a major exporter of the kind of commodities that matter for the economies of China or others. It's more like Brazil and Chile, and it's things like copper and things like that. So I think India is actually a beneficiary of the deflation coming out of China. And then, of course, there's the political stability issue that I think that box got checked as well. So it's looking pretty good.
All right, looking pretty good. Thanks a lot for joining in, Ed. Appreciate your thoughts here on CNBC TV 18. Let's slip